Good morning. It's November 25th. The market's caught in a tug-of-war between a dovish Fed and some really weak data. Here's the pre-market game plan.
All right, let's break this down, because everything, everything is hinging on this conflict. On one side, you've got the bulls, banking on a Fed pivot and that classic strong holiday seasonality. But on the other side, well, that's the bears, and they're pointing to a steady drip of bad economic news, real cracks starting to show in the foundation.
So, let's get into the specifics. What's the data that's driving this big divide?
Okay, the bull case is all about the Fed. You've got officials like Daly and Williams now openly talking about rate cuts, and the market's listening. It's pricing in an over 80% chance of a cut in December. So the big test, the real catalyst, is the upcoming PPI report at 8:30 a.m. Eastern. That's going to confirm or deny this whole dovish story.
But here's the counterpoint. Look at the consumer. Consumer confidence just tanked to 88.7, a 7-month low. We're talking about levels that are getting uncomfortably close to the COVID crisis lows. That's a huge red flag for spending down the line.
And it's not just confidence. The labor market is starting to show some real cracks. Yeah, the headline number looks fine, but dig a little deeper. A record 25.3% of everyone unemployed now has a 4-year college degree. That's according to the BLS. And that tells you the weakness is hitting a really crucial group for the economy.
All right, so how do we translate all of this into what matters for today's session? Let's talk macro risks and the key numbers you need to be watching.
The big one, no surprise, is today's PPI report. The consensus is looking for basically a flat number, something between 0 and 0.1%. Look, a soft number here gives the bulls everything they want, but a hot number, that could shatter the whole narrative. Meanwhile, the VIX is just sitting below 20, which tells us there's not a lot of institutional fear out there. They're not rushing to buy protection. And you just can't ignore that historical tailwind. This November-December period has historically been a monster, averaging a 6.4% gain in setups just like this one.
Now let's drill down. Where is this battle playing out on the stock level? Right now, the AI space is ground zero.
We're seeing a really big rotation happening inside the AI sector itself. Google is on a tear, right? News about Gemini 3 AI, plus reports that Meta might be using its TPU chips. That's a direct shot at NVIDIA. Now, Google looks pretty overextended after a 3-day gap up, but the news is real, and that's putting serious pressure on NVIDIA, which is now testing that critical $164 to $165 support zone. And you got to watch AMD here for any collateral damage. Keep an eye on support at 200 and 196.
Just a reminder, this content is for educational purposes only. It's an aggregation of public sources, all to help you stay informed and sharpen your own decision-making. Please do your own research. This is not financial advice.
And hey, if this is helping you frame the market, go ahead and subscribe and turn on those notifications for our new weekly market update playlist. That way you won't miss any of the future recaps.
So, with all that said, how do we actually trade this divergence?
You absolutely need a framework for this, so let's lay out the key market scenarios and how we can posture for each one. A base case, a bull case, and a bear case.
Okay, let's use SPY as our guide here, looking out over the next 1 to 2 weeks. The base case is just chop, sideways action, while we wait for that PPI catalyst. For that to hold, we need to see NVIDIA stay above 164.50 and SPY stay under that 676 resistance. That means our posture is neutral tactical. The bull case gets triggered if we get a soft PPI print, confirming the Fed is ready to pivot. The signal would be SPY breaking and holding above 676. That's when you can get cautiously long. And the bear case, that comes from a hot PPI print, or if these data fears just get worse. The tells would be NVIDIA breaking below 164.50 and SPY getting rejected hard at 676. Your posture then flips to cautiously short, or maybe just back to cash.
So let's boil down the bull thesis. It's simple. A dovish PPI number confirms the Fed pivot, it lines up perfectly with strong seasonality, and that's the fuel that drives SPY right through that 676 resistance. The key risk? A hot inflation number comes in and just completely invalidates the whole thing. And the bear thesis is just the opposite. It's the idea that this deteriorating economic data finally becomes too much to ignore, that it overrides any hope of a Fed rescue. The trigger is SPY rejecting at 676 while NVIDIA breaks its key 164.50 support, sparking a tech-led sell-off. The big risk to this view, of course, is that the market just shrugs off the bad data and rallies on pure seasonality anyway. All right, for traders looking to express a view on one of these scenarios, let's walk through a defined risk option strategy.
Let's take that bearish thesis on NVIDIA as our example. Step 1 is the thesis itself. We're looking for a break of that 164.50 support because of macro weakness. Step 2 is how you structure the trade. For example, you could look at a December 160 by 150 put debit spread. Step 3, and this is key, is that your max risk is completely defined. It's limited to whatever premium you paid for that spread. That's it. And finally, step 4, you have a crystal clear invalidation point. If NVIDIA reclaims and holds above $165, the bearish idea is off the table.
And now a critical warning about options. All trading involves risk. Your capital is always at risk. With some strategies, losses can even exceed the premium you paid. What we just discussed is an educational example, not a recommendation. Always remember, position sizing and stop-loss discipline are absolutely essential.
If this is helping you navigate the markets, a like and subscribe would be great, and make sure to turn on those alerts for the next morning brief. Remember, this is not trading advice. It's a market update to keep you informed. All markets carry risk. You have to trade your own plan, manage your downside, and always verify all data for yourself. And that really leaves us with the one question that will define today's session. Is the market's historically powerful bullish seasonality strong enough to make traders ignore the very real cracks that are starting to form in the economy?